Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Dominion Energy is a regulated electric and natural gas utility serving more than 7 million customers across Virginia, South Carolina, and North Carolina, one of the most important utility franchises on the East Coast.
The company traces its origins to 1909 and Virginia Railway and Power. Over a century of growth and consolidation, including the 2000 acquisition of Consolidated Natural Gas, built it into a large regional utility complex.
In 2020, Dominion went through a significant reset. It sold gas transmission and distribution assets, including Questar and Scana gas properties, and cut its dividend as part of a strategic pivot toward the regulated electric business.
That reset was painful but strategic. The company focused capital on its core Virginia and South Carolina electric franchises, where rate-based growth and clean energy investment create a compelling long-term trajectory.
The most important structural tailwind is Northern Virginia's data center corridor. This region hosts the largest concentration of data centers on the planet, and Dominion is the exclusive regulated electricity provider for that territory.
That data center load is structural and accelerating, not cyclical. As cloud computing, artificial intelligence, infrastructure, and digital services expand, the electricity demand Dominion serves grows right alongside them.
Offshore wind is the other major growth pillar. Dominion's Coastal Virginia Offshore Wind Project, a 2,600 megawatt development, is one of the largest offshore wind builds underway in the United States.
Because Dominion is a regulated utility, these capital investments flow into the rate base and earn a regulated return, meaning offshore wind construction is not just an environmental initiative, it's a predictable earnings growth driver.
Rate base is growing at roughly 9% per year, driven by offshore wind construction, grid upgrades, and data center interconnection investments, a pace that significantly exceeds the historical utility average.
The dividend was cut in 2020 as part of the asset sale and restructuring. Since then, Dominion has posted approximately 4 consecutive increases from that reset, modest recovery, but the income story requires accurate historical context.
Competitively, Dominion sits alongside Duke Energy, Southern Company, and AEP. Its differentiation comes from territory. Virginia's data center demand and the offshore wind development rights are unique to its franchise.
Robert Blue has been CEO since 2020, steering the company through the post-reset period. He came up through Dominion's legal and policy functions, critical skills for a highly regulated business navigating complex clean energy legislation.
Key threads: offshore wind construction milestones and cost management, data center load growth and interconnection timelines, rate case outcomes in Virginia and South Carolina, and the pace of dividend recovery.
Dominion is a utility in transformation, leaning into structural electricity demand growth and a massive clean energy capital cycle that should drive above-average rate-based growth for years ahead.
That's the company chapter for Dominion Energy. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Dominion Energy beat on earnings as data center demand accelerates in Virginia. Q1 2026, EPS of 0.95 versus estimates of 0.89, a 6.7% beat. Revenue grew 13.3% to $5.02 billion. Hyperscale data center load in Northern Virginia is redefining the demand outlook for the nation's most important regulated utility territory. This is Charged Alpha. Let's break it down.
Dominion Energy is one of the 10 largest U.S. electric and natural gas utilities, market cap of $51.2 billion. The core operations cover Virginia, North Carolina, and South Carolina, serving approximately 7.5 million customers. The Virginia territory, which includes Northern Virginia's technology corridor, is the highest growth regulated utility service area in the United States by data center load growth.
The utility business model is straightforward: regulated returns on capital investment, approved by state public utility commissions. Dominion earns a formula rate on its transmission and distribution investment, and its Virginian electric operations are regulated under Virginia's CPCN framework, which provides a defined return on equity of approximately 9.4%. The moat is the regulatory monopoly.
Let's walk the income statement. Q1 revenue of $5.02 billion grew 13.3% year over year, a rate unusual for a regulated utility. The acceleration reflects load growth from data centers in the Dominion, Virginia territory. Hyperscalers, Microsoft, Amazon, Google, Meta are expanding Northern Virginia data center capacity, which requires incremental transmission and distribution investment by Dominion.
EPS of 0.95 beat estimates by 6.7%. On a full-year basis, management reaffirmed guidance of 340 to 358, a 5% EPS growth range. The regulated utility framework caps upside but also protects the downside. Earnings growth is a function of the capital plan approval and rate base expansion, not commodity prices or customer churn.
Cash flow and balance sheet. Operating cash flow of $1.2 billion reflects the capital-intensive nature of utility operations. Total debt of $29.4 billion against $400 million in cash is a highly leveraged balance sheet. Net debt of $29 billion represents roughly 5.7 times EBITDA. This is high even by utility standards and is Dominion's primary investor concern.
The leverage has two causes. First, Dominion sold off multiple business segments between 2021 and 2024, including the gas transmission and storage assets, at prices that did not fully offset acquisition-era debt. Second, the Virginia data center build-out requires massive capital investment in grid infrastructure, transmission upgrades, new substations, reliability investments that is funded with debt before rate-based recovery.
Wall Street sentiment is mixed, reflecting the leverage concern. 5 buy ratings, 11 holds, 2 sells. Average price target of 58.50 implies approximately 10% upside. The hold-heavy consensus reflects investor preference for utilities with stronger balance sheets. Duke Energy, Southern Company, and NextEra trade with less leverage and command higher price-to-consensus target ratios.
Valuation. Dominion trades at approximately 27 times trailing earnings and 17 times forward 2026 estimates. Utilities are inherently yield-sensitive, and Dominion's dividend yield of approximately 3.8% is in line with sector peers. EV to EBITDA is in the 14 times range. The forward PE of 17 is reasonable for a utility with 5% EPS growth guidance.
The data center load story is the key differentiation from generic utility investment. Dominion's Virginia territory is absorbing gigawatts of incremental load demand from hyperscalers, a pace of growth not seen in a regulated territory since industrial electrification in the 1950s. Evercore upgraded to buy in April, citing data center load growth as a decade-long structural tailwind that will grow Dominion's rate base at above sector rates.
Cautious analysts flag the rate case risk. Dominion's ability to earn the approved return on equity depends on successful rate case filings with Virginia regulators. If regulators limit the pass-through of data center infrastructure costs, arguing that hyperscalers should directly fund the grid upgrades, Dominion's capital plan economics deteriorate. 2 analysts carry sell ratings on this regulatory execution uncertainty.
Beta is 0.39, highly defensive. Forward EPS for full year 2026 is 348, putting the stock at 16.3 times next year earnings. Regulated utility EPS growth of 5% compounding over a decade, combined with the dividend yield, suggests a total annual return of 8 to 9%, below the market but with significantly lower volatility.
The bull case rests on 3 pillars. First, Virginia data center load. Dominion is the sole regulated electric utility for Northern Virginia, the world's largest data center market by concentration. Incremental load translates directly into capital investment, which earns a regulated return and grows the rate base. The load pipeline is multi-year and largely contracted.
Second, nuclear fleet life extensions. Dominion operates 4 nuclear reactors in Virginia. Life extension approvals add decades of baseload generation with 0 carbon emissions and low operating costs. Nuclear provides both regulatory and ESG credibility as states push for clean energy mandates.
Third, Rate case certainty. Virginia's regulatory framework under the COVA law provides formula rate review annually. Predictable regulatory outcomes reduce the binary regulatory risk that plagues utility stocks in less favorable states. Management has a track record of constructive outcomes in Richmond.
The bear case starts with leverage. $29 billion in net debt with rising interest rates creates refinancing risk and limits balance sheet flexibility. If interest costs rise by 50 basis points on rolled debt, the interest expense impact compresses net income meaningfully. Equity must be raised to fund the capital plan, which dilutes existing holders.
Second, offshore wind cost risk. Dominion's coastal Virginia offshore wind project is one of the largest offshore wind developments in the U.S. Cost overruns, which are endemic to offshore wind, could force rate-based write-downs or regulatory disallowance of capital recovery, a meaningful earnings risk.
Third, interest rate sensitivity. Utility stocks trade inversely to interest rates. If the 10-year Treasury rises above 5%, Dominion's dividend yield becomes less attractive relative to risk-free alternatives, compressing the PE multiple regardless of earnings performance.
The utility peer group includes Duke Energy, DUK, market cap $90 billion, Southern Company, SO, $80 billion, and NextEra Energy, NEE, $160 billion. Versus Duke and Southern, Dominion has faster load growth but more leverage. Versus NextEra, Dominion is valued at a discount reflecting the balance sheet and regulatory execution uncertainties.
Options activity was neutral. Put-call ratio of 0.98 reflects balanced positioning, income investors holding the yield, rate-sensitive bears buying puts on 10-year Treasury watch. Implied vol is low, in the 15th percentile, consistent with utility sector character.
No significant insider transactions in Q1. Management is focused on the CPCN filings and grid modernization rate cases. Institutional holders include Vanguard, BlackRock, and State Street, standard index weight utility positions. No activist involvement. The leverage story does not lend itself to shareholder activism.
Bottom line on Dominion Energy. The Virginia data center load story is a genuine structural tailwind that differentiates D from most utility peers. The earnings beat confirms the load-to-earnings translation is working. The leverage is the limiting factor. It constrains total return potential and creates rate sensitivity. For income investors comfortable with utility yield and a 5% EPS grower, D at 17 times forward earnings is fair value with upside if data center load exceeds current projections.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.